Hi everyone, this is Jeremy with YouPlan. Today we're going to cover the rent or buy the financial model here. And this is for people who want to make a decision on whether or not they want to rent a property or they want to buy a property for a given set of years. So you can choose 2 years, 5 years, 10 years, whatever year you want. And this model will spit out what is the better financial decision as it relates to your net worth. So what I'm going to do is just going to cover the Excel template as a whole. We're going to run through a Excel model, and then I'm just going to talk a little bit about the recommendation and some of the assumptions that are built into that. So this first page is just an overview. It shows you what you're going to get from this model, what you need, and then a little blurb here on personal support if you have any questions. So that said, I'm going to turn over to the analysis tab and just explain to you the overall template, and then I'll zoom in and talk a little bit more about the details of some of the inputs. So what you're going to see here is all the way on the left, you're going to have 3 different types of inputs: the basic input, your rental input, and buy input for this. So this is all the information that you're going to need to spit out the financial model. So anything in these yellowish cells are inputs. What you can do is you can either click on some of the drop downs to get the values you need, or you could just type them in yourself. And then also do have a few comments here on the side that go into a little bit more detail of what's contained or expected within those inputs. So then in the middle, you're going to have, this is going to be the decision recommendation as it's illustrated in the graph. The way to read the graph is it shows you your change in net worth on a given time period for whether or not you rent or you buy. So your change in net worth is taking all your assets and your liabilities and only focusing on whether or not you rent or buy at a given point in time. So the model allows you to choose different years. So if you want to choose what happens in year 3 or year 10 or year 15 or all the way up to year 30, it'll tell you at that point in time what the best decision would have been if you were to rent or buy given the scenarios. It'll also tell you at what point it'll break even. So that will say right here in the words right below the top 5, the top recommendation for the years. Then on the right, you have all the detail, plugs in all the upfront expenditures, reoccurring costs, and back-end expenditures. I'll cover that in a little bit more details as we move forward through the example. So what I'm going to do now is just going to zoom in here, and we're going to cover an example and just talk about some of the inputs and then the recommendation. So for this scenario, we're going to ask ourselves whether or not we'd be better off renting or buying in a 5-year period. So I'm going to plug in 5 here at the top. Then I'm going to have this. So this is for the opportunity cost metrics, the estimated return on your investments. So when you purchase a property, you're going to have to put a pretty decent amount of change here for your down payment. So your down payment, let's say it's $20,000. You could either put that in as a down payment, or you could invest it in the market. And so what this is the estimated return on your investments in the market. On the right here, if you look at my comment, it shows so estimated investments, assuming if you had a very conservative portfolio, is around 3%. If you had a very diversified and mixed portfolio, you can assume around a 7 to 9%. So that's if you're really well diversified. If you take on a little bit more risk, maybe a little, with that comes a lot of volatility as well. You can assume around 12% at a very high end, and that's a historical non-inflation adjusted S&P return. So for this example, we're going to stick with just a 7% return. Then at the bottom here, you have the tax information. So tax, we're just going to assume a 22%. So you'll notice this is the effective tax rate. So what the effective tax rate is, what you, at the end of the day, if you summed up all that you spent for taxes for federal and state, and you divide that over your pre-tax income, that will be your effective tax rate. So it's not to be confused with your marginal tax rate, which is the tax rate that bumps up in increments based on your tax bracket. Then we're gonna assume 22% for that one, and then we're gonna move on to the property taxes, which for property taxes, I live in a pretty high cost state, So I'm going to say 1.3%, but it could depend based on your location. So we're done with the basic inputs. We're going to get in a little bit more detail with the rent inputs. So it's broken down into 3 sections: the upfront expenditures, which you could expect to pay either during signing. It's a one-time fee that you're gonna spend to be able to rent the property. Then you have recurring monthly costs, mostly your monthly rent and estimates based on rental increase, renter's insurance if you have any, and then utilities. And then any back-end expenditures. So if you paid a down deposit, if you're expecting cleaning fees or anything other that can creep in there. So I'm going to assume we are in a moderately high-cost environment. So maybe the deposit is going to be around $1,500. I'm going to zoom in here just so we can get a good look at that. So type that in here, and that will filter into my model. Then you have the application fee and background fee and other, and I'm going to keep those at around 100. Again, it could vary based on your rental complex. So then you have the recurring costs. So if you look here, so the monthly rent payment. So I assume the deposit is $1,500. What I'm going to do is, and maybe I'll assume that the monthly rent is also $1,500. So I'm going to plug that in here. And what you'll notice is my chart changed slightly. So it went from 1,700, 1,500, and that's because it's less expense. So this blue line hugs upward because it's a change in your net worth. So you're spending less, so you're less negative in your net worth. So it's less of it. So it's a positive thing. For all the years outward, I'm assuming a 2% growth, which is loosely tied to inflation. But if you live in a California or New York area, maybe that's going to be a little higher. So I'm going to assume around 5% growth. And you'll see is that'll drastically change my net worth in the outer years. Then, of course, you have renters insurance, cable internet, electric, water, gas, and I'm not going to change any of those. They seem pretty in line with some estimates. The back-end expenditures, deposit redemption, I'm going to assume I did really well and I didn't cause any damage. I get my deposit back, but I have to pay $100 in cleaning fees. Okay. So now let's get down to the meat. So the buy inputs. So this is assuming, so on the one hand, you could rent. On the other hand, you could buy. So what we're going to have here is the inputs for your whether it's a mortgage that you have, and then also your interest rate and duration of your mortgage term. So first, we're just going to focus on the property value. So let's assume here the property value here I have around 225. Let's just, for the sake of it, to change, I'm going to assume around $200,000 property. And so that would change. Very similar to the rent increase per year. I'm going to assume a 2%. Maybe the property appreciates slightly slower in my area than rental. So I'm going to assume a 2%, which is pretty close to inflation. So now, let's say I move into the property, but I want to do a little bit of renovation expensive. I've been watching a lot of HGTV. I feel good about where I'm at construction-wise. And so what we're going to say is I'm going to assume that I'm going to spend around $10,000 for renovations. And because of my $10,000, I added $5,000. So the total value added here is $15,000. So just to reiterate here, that's a net add of $5,000 just because you did the renovations. Then this model also allows you to choose the year. I'm going to say, let's say I take on that project maybe in year 3. How's that? Next are the mortgage details. So the mortgage details are going to be your interest rate. So it's 2018 right now. The interest rate around 4.5 if you have pretty good credit. Maybe you have credit that's not so hot. Maybe I'll bump it up just slightly to 4.75%. The mortgage term here is at 15. You can choose a 15 or 30 year. And for the sake of the example, I'm going to go to 30 year. And I'm going to assume that I'm doing a 20% down payment. So I'm just going to pause here. So the 20% down payment based on a property value of $200,000 is going to be about $40,000. So the loan amount is going to be $160,000. So if you add these two together, so your cash $40,000 plus the loan is going to equal the property value of $200,000. So when you buy a property, you do have a few upfront expenditures such as bank and legal fees. In my area, that's pretty comparable: 1,000, 1,500 for legal fees, and then of course 500 just for other, any other buffer for miscellaneous fees that you need to pay. Then you have reoccurring costs. So maybe you have an HOA fee or you have homeowners insurance. So HOA fee, if you don't know what that means, is a home ownership association fee, or it could be a co-op fee or any type of fee that you have to pay outside of your mortgage and utilities to be able to live in the residence. You keep that around $100 per month, and then the homeowners insurance here is at around $80. So the way I got this is in a very broad sense of the way of terms. You can expect to pay around $35 per month for every $100,000 of your home value as it relates to homeowners insurance. Just so I name my source. The source for that is from Zillow. So here we're at $80. Maybe I'll take Zillow's recommendation on what the estimate would be, and I'll match that to 70. And then of course I have the cable, electric, water, gas, parking, and other, and it gets to my monthly mortgage payment of $835. Then in the back end, assuming I sell the property at a given year, you're going to have a broker commission. So 6% is pretty average for broker commission, and the source for that is Redfin. And then you have legal fees, other, and then the real estate broker fees. That's just a calculation, and that's all done for you. So you go up to the top, you're going to look at your recommendation here, and it's quite obvious that you're much better off buying rather than renting. So you look at this green line here. It shows that it'll take you 2 years to break even, and then after that, you're a lot better off buying than you are renting because of the expenses that you're going to incur in renting. So what's contained within that number? I'm going to go over to the right here and show you just a little bit more detail. And in the spirit of not going over anything I just talked about, I'll cover the things that are maybe not so inherent. So we have plugged in our model over 5 years is what we're interested to learn about whether or not it's a rent or buy decision. So we plug that in here. The upfront expenditures are here. Those are all one-time fees. Then you have your reoccurring costs, your monthly rent payment, your renter's insurance, your utilities or mortgage or property tax. Those are all your reoccurring costs. And then you have the back end expenditures that only occur once. So that's either when you check out of your residence and you get your deposit back, or back end expenditures such as your real estate broker fees or legal fees when you sell your property. So at the bottom here, we have a nice little tally here, and it shows your expenses. The expenses here for renting is from around $1,020,000. The expenses for buying is around $1,100. Now let's talk about the benefits. This is where it could get a little hairy in terms of conceptualization of why the benefits are what they are. So assuming you had your down payment and you invested in the market and you had that 7% return, what you would expect to get based on that 7% return after adjusted for inflation is around $16,000. But then you also have to factor in capital gains, assuming you sell it in 5 years. So your total change in net worth is going to be $106,000 worse in your net worth. And the reason of that is primarily because the expenses are going to supersede the benefits here of your returns on your investments. So now if you look on the right side here for your buy portion, it says the total benefits are going to be around $44,000. And the chief reason for that is the estimated property appreciation. Factored in to that number is renovations that you'd made, then also that 2% that you get every single year. Then assuming you sell the property in 5 years, you're going to have capital gains tax. But offsetting some of that is you're going to have property interest tax benefit. So whenever you file your taxes at the end of the year, the interest payments that you pay serve as a tax shields. So you get some of that money back on your tax returns every single year. So that's factored in there, along with your home equity gained. So whenever you pay a monthly mortgage payment, part of that goes to the payment of the interest, which you get the tax benefit on. But then a lot of that is also going towards equity. So the equity is when you sell the property, it's yours to keep, that you can then transfer to either liquidate and use as cash, or you could use toward another property. So the change in net worth in the buy scenario is you're going to be negative $66,000, which is less negative than if you were to rent, which is negative $106,000. So you're better off in 5 years by around $40,000 to buy rather than to rent. I'm just going to run one other scenario just to make the buy scenario a little worse. We're going to go down to our property details. I'm going to assume instead of a $200,000 house, let's say I'm looking for a $400,000 house. How does that change things? So if you see that, that will change this value. It also changes the down payment and loan amount. So higher principal that you put for the property values is going to increase your interest expense. Then you're going to see what happens is over 5 years, you're actually around 11.4K better to rent than you are to buy. And the reason is primarily because of your mortgage payments and the money that goes out the door towards paying interest. So in this scenario, because you have a higher house, and it's going to take you around 7 years to break even. So I hope you guys found this very insightful, and that you use this tool and you really enjoy it. If you have any questions, please feel free to reach out at youplan.contact@gmail.com. Again, this is Jeremy. Thanks so much for watching.